Welcome back, folks. This is our final installment for the algorithmic order flow. We're going to continue our discussion on changes in the state of delivery. All right, our example back at the euro dollar. Now again, I should have earned by now the right to be able to talk like this because we were outlining these things in advance, but nonetheless, I want to give you the details as to what transpired and what I was seeing, what I was anticipating, and how these things mesh together from the core content you learn in the mentorship. So this is a 15-minute time frame. So my chart is trained in on a lower intraday chart, but using the context derived from that higher time frame daily chart. So we're looking at the section that was referred to at the beginning of this teaching series on algorithmic order flow and referring to the buy program. So we're looking at the buy program here, and I want you to take a look at this fractal and price. And once you do this, you'll start seeing how to go into your charts and annotate them for your own study journal. Now, obviously, I'll teach more in regards to how you should log and record experiences and price actions. So that way you're feeding your understanding, you're giving yourself pseudo experience, so that way it'll be easier for you to identify these things in the future before they unfold. But right away, I want you to take a look at this level right in here. Stops, retraces, consolidates, drops once more, then rallies away. The buy program begins here, but we wait for an initial displacement. We have it here. I mentioned on the previous discussion how we ran buy-side liquidity there. So there's a change in the state of delivery. Once price starts going lower, the state of delivery is on sell side. It's dropping down until it gets to a period of old buy-side delivery, which is this imbalance right there. So notice it does not completely come down into that last down close candle here. So the state of delivery in this run is buy side, changes to sell side in the bullish context. So your framework is watch this imbalance, watch the last down close candle. So think about that paint roller analogy. Paint is applied and needs to come back down, starts to go back up, but doesn't completely close that in until we get down into that last down close candle, and it trades to it here. So what's occurring here is the imbalance is what you identify as the stage. Then you watch to see if it has any sensitivity once it comes back in here. And does it have any sensitivity? No. It's lethargic. See how yes, it's going up. I mean, if we were going to be splitting hairs, yes, there was a small minor reaction there. But is it dynamic like this or like this, where it's showing a willingness for the algorithm to want to reprice away from it? No, we're not seeing that. So when we start seeing these things like this algorithmically, you should be identifying that as, okay, it's likely to still come down here and close in this unfinished business. So the last down close candle, that's your bullish order block. When it trades to that, yes, then you'd anticipate the algorithm to start spooling and moving towards buy side liquidity here. Now, once buy side liquidity is traded to during buy side delivery of price, now I'm going to say that again. Above this high is buy side liquidity resting in the marketplace. It's orders. Okay. Buy side delivery is when the price is going up. The algorithm is offering it on buy side. So it keeps going up, 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 up. Notice that when we trade to the buy side liquidity, there's a small little imbalance right in here. So that small little imbalance while we trade into the buy side liquidity, that's all that's required to trade back into and rebalance. That's all that's necessary. Now, this is when you see those instances of classic support resistance theory supposedly working. But I'm going to show you in this teaching here why it doesn't work like that and when it's likely to fail and how you can use the real insights with the algorithm. So we have the imbalance here traded to, and then we have another measure of displacement on the upside. We create relative equal highs, which builds in and engineers more buy-side liquidity. Traders are going to look to see this as a shorting opportunity, especially with this drop down here. Now, I want you to look at this area right there. Now, classic retail traders and support and resistance theory says that with this high being broken here, we want to see it trade down to that, and then that'll be the buy, or that's where the market should turn. I want you to look at all of this price action in here. And algorithmically, I want you to think about what IPTA would need to do to reprice efficiently. We have a run here that fails to go above this high, and then it declines. It trades lower. So we have a breaker. These up close candles, that's your bullish breaker, and it has an imbalance with institutional order flow entry drill with this candle's low. So we trade back down through this old high, which would be expected to be reasonable because we have a breaker, we have an imbalance. It trades back down into that bullish breaker, institutional order flow entry drill, and it trades into where buy side was offered. In other words, this is buy side delivery. The price is being delivered on the upside. When the market trades back down during sell side delivery, it changes its state of delivery when it enters an old area of buy side. So there's an overlapping of where old delivery was bullish. If it trades back down into that with sell side, that's when you anticipate the algorithm changing its state again back to buy side. That's the real quote unquote dynamics of why the algorithm is doing what it does and why order blocks and inefficiencies actually are of any importance. But the factors are, as I'm outlining here and in all the previous discussions in this series. Then we have what? Displacement again. Institutional order flow entry drill trades into it here. Another level of displacement on the upside. Moving forward a little bit in price, we still have this imbalance here. So we had institutional order flow entry here, profitable, but for a longer term position trade or a longer term swing trade intraday, it may require to trade back down into this imbalance. So we know the imbalance range and its premium level, its discount level, and in the middle is consequent encroachment. Trades to it here and offers another level of distribution. Now in this price run from here to here, I want you to think about what imbalances reside still. We still have the bottom end of this, but we have a lot of sell side liquidity resting below here. And notice how price was delivered. We have buy side, then it trades at the close. Buy side, and then buy side, one single pass in here. Then we have buy side offered after it trades down a little bit and rallies here. And then this candle rallies again. So there's a lot of give and take back and forth in here, except for this small little area of inefficiency right there. That is your bullish discount fair value gap. Okay, it's a small little capsule of buy side imbalance. That is all that's necessary for the algorithm to come back down from this high to this low, trading back down into what would be considered a discount market. So at a later time, this is going to be influential if we lose this low. Why this low? Because if it came down here and didn't fill it entirely on this imbalance, and then it came down here and rallied, it won't come down here just to rebalance again to go higher. Why? Because it's underlyingly bullish, and it's going to probably need to go, if it goes back below here, it will look for a deeper pool of liquidity so that way it can buy from willing sellers at a lower price. Remember, there's traders that are long and they're trailing their stop loss. When the market's over here, their stop loss is going to start pulling right here. So do we just expect it to go right to that level here or to the big figure? No, we can anticipate a run to the big figure, but once we trade to a big figure, what's the protocol there? It can go 10, 20, 30, 40 pips. This is that imbalance. We just moved the chart a little bit forward in time. Notice that we had buy side liquidity traded to it here, and one more time up in here. We'll get into this area in a moment, but I want you to take your attention to right there. So we have that small little imbalance. We extend that out in time because you and your development will not know exactly when it's going to trade to that level, but you want to have it on your chart should it trade there. So we had a run above buy side liquidity here. Then the change in state of delivery is on the downside. So sell side's being offered. And then we have a break in market structure. This break in market structure after, now this is important, folks, algorithmically, if we trade to buy side liquidity like this while we're in a bullish market environment or buy program, if we trade the buy side liquidity and then the market breaks down, it takes out the run that led to that buy side run, taking out liquidity. If it breaks that, then this becomes a bearish breaker. We trade up into it here with an imbalance. Does it completely close it in? No. It goes back to a period of buy side delivery. See these candles here? That's your bearish order block. That low with the imbalance, which is consequent encroachment as well, inside of the bearish breaker. Here, here, order block. There's your turning point. Runs, if it breaks below here, remember the protocol would be it's going to attack the sell side liquidity. To do that, it's going to reach for what? It's going to reach for this level here. Why would it do that? Well, if you look at the range between that low and this high now, here's 62% retracement, 79% retracement. That's optimal trade entry, but we're more specifically below the 50 level. Why go below this low, Michael, for sell side liquidity? Why not just this one? Because this would take us to a discount or an equilibrium. So at equilibrium, so trading back to discount or to equilibrium in a bullish buy program is the same thing as saying it's a discount, but not just to that level. We want to look for a PD array. So the PD array is the fair value gap there. So we're going to identify this level here with these green dashed lines. All that's doing is highlighting the fact that this is optimal trade entry 62 and 79 respectively. But specifically in a precision based perception, this is the actual PD array we're aiming for within the optimal trade entry. So it's not just, okay, I'm looking for an optimal trade entry trading at 62% retracement. We're looking at what specific imbalance or what PD array in this case does it need to trade down to for a discount, and will there be precise delivery to that and sensitivity after it's traded to it. And again, focusing here for the imbalance breaker, and again expecting price to trade below here, and here's that breaker trades to, and then we trade down, consolidate, and go right into that fair value gap. There's the levels, consequent encroachment into optimal trade entry. Is there sensitivity there? Yes. What's happened here? We ran to another level of buy side liquidity. So we have a change in state of delivery. It starts going down. So we have sell side at a time when we're inside of a larger time frame buy program. Don't lose sight that this 15-minute chart is going back and forth, up and down. The ebb and flow is not as critical as understanding what the higher time frame bias is during the same time period. Again, if you're just watching this video and you have not watched the previous 3 videos in this series, then it's not going to mean as much to you because you have obviously the higher time frame levels in mind in addition to what's being shown here. Otherwise, I would have too many things on the chart. But I want you to go and look at your chart here as it trades down into this fair value gap right there. Where is this occurring in the context of the daily chart on Eurodollar? And you'll see that you're trading down into a bullish fair value gap that's a discount on the daily chart. And this is actually institutional order flow entry drill on a daily, not just focusing on what I'm outlining here. So I'm bringing everything together that frames and models the buy program and where the actual turning points IPTA will do and how precise it is. But this buy side delivery here and it starts to drop down, what is it doing? It's running short-term sell stops and returning back to bullish breaker. There. Consolidates and then runs. Once it takes this high out here, another level of buy side liquidity, we can start seeing all the sensitivity and returning back into the imbalance right there. So this price run here starts the next level of advancement to attack this high. Scooting on over in the future, we have the low still, and we run up to this level here, and then this here. This displacement is taking traders out that are trailing stop loss orders as it runs higher. Look at this low to this high. Imagine, you don't need a fib to do this. Imagine where 50% would be. From here to here, where's half? And what would reside just at 50% of that range or below it? We have an imbalance in here. We have sell side liquidity here. And we have an order block, the last down close candle right before this displacement on the outside. So we have the market run down into the order block. A little excitement on the downside, but that's fine. In here, I want you to take a look at what's going on. We have the high and price running to and through. So why doesn't it just go back down like the previous example where I was saying that old highs isn't the be all end all for buying? If it breaks above old highs, it's not going to act as support all the time. And it's not always the case when we have a little imbalance here that it would trade not just to this old high, but down to this imbalance and then go higher. That's what you would reasonably expect. This is not what the algorithm does. You have to consider what has just transpired. The algorithm has traded down, and the change in the state of delivery for stop running sets the tone for not needing to come back down to this, but needing to come back into this displacement. So think about how we started the buy program and we were looking for certain things to be there. This creates like another minor or smaller buy program within the larger buy program. So it creates another fractal. So the change in the state of delivery here starts with the stop run. This is important because the fact that we ran stops on the sell side now indicates that it does not need to come back down in here again. So when it runs higher and takes this high out, when it retraces lower, we don't look for just imbalance right in here. We look at the breaker here because why? The context is a stop run just took place. So don't think that it needs to come back below this low again, or that it needs to just only trade here. Anticipate it trading to the breaker and any imbalance that starts here with the last down close candle. So think the same thing that started the buy program initially in this teaching, in this very video, and how this is very close to what was the beginning of the buy program. We wait for that displacement, then it comes back down into the last down close candle. Everything's repeating here within the larger context of that daily buy program. The market trades to the order block here and runs, but look what it does. It just takes out this high on a very shallow basis. That's indicative when you're bullish that we're going to retrace again, and the only thing you need to look for is not a run back down below this low, because this only referred to this order block after the stop run. So neither this low or this low needs to be traded through. So the logic algorithmically is, okay, this low's in place. It's not likely to be, if it takes this low out, we have a deeper retracement in order. And then if it goes below this low here, it's not just taking this low out, it would probably run for these relative equal lows over here. And then that would upset, in my opinion, the buy program. So you would have to move to the sideline. Now, I just gave you a mouthful, but I'm telling you exactly what the secrets are on how to work within the algorithm within a buy program. Everything I'm saying here would be reversed if it was in a sell program. But back to this shallow run initially above this high. If it runs here and it starts to drop from here, where is it going? It's going to an order block or an imbalance. We have both here. We have a small little fair value gap and the last down close candle within this run. So this is all that's required. So your eye should go right to that. There's your order block. It trades down to it here and then starts to build another price run higher and more meaningfully trades through these highs. Moving on into the future, keeping everything as it was in the previous slide. No real imbalance here. It just trades to it, finds some support. This is your classic support resistance idea. There is no imbalance that it needs to drop that down into. It's also a run on sell side liquidity here. So there's no necessity for it to trade back below this low now because it's already done its work by taking stops. So when you go through your charts, you want to do things like this. You want to annotate your charts, and the things I'm saying verbally, you would actually type those things out in annotations. So that way when you're looking at your charts, if you look at charts that are like 2 years old, 3 years old, or even a couple days old, you may have forgotten what the context was around that specific element in terms of like an intraday chart. And you also want to include on your charts the higher time frame narrative. So somewhere in the chart, you would have an area where like daily perspective or daily chart perspective or higher time frame perspective, you would remind yourself of specific key points in price action as to what frames or models this specific buy program and why it's important for that particular fractal that you're logging and annotating for your study journal. So hopefully you found some insight from this one. Until I talk to you next time, be safe.